The banking sector has remained a front-runner for investors owing to the impressive returns the sector has posted over the years. But with rising competition in the sector, clear variances have emerged between the efficient banks and those that are yet to fully maximize their potential. And as Adelaide Changole tells us now, it would seem that traditional heavy hitters have had to play second fiddle to the more leaner and nimble banks.
I think the banking sector has done very well in the past and is expected to do well. Their average return has been well over 20%.
This has made the banking sector a darling for investors seeking high yields, a fact that has made the banking counters the ones to beat at the Nairobi Securities Exchange.
More than 40% of the stock market is banking sector.
Efficiency and effectiveness have become increasingly important, and it would seem that some listed lenders have done a better job than others, according to the latest banking sector report from investment firm Seaton Investments. The report highlights the performance of banks based on 11 metrics, among them the loans to deposit ratio, the cost to income ratio, deposits per branch, and non-performing loans to loans ratio, among others. Once tallied, CFC Stanbic and I&M Bank beat out heavyweights like KCB and Equity Bank, which could not shake off the impact of higher costs, lower deposits per branch, and higher non-performing loans, despite having high net interest margin and high price earnings to growth ratios.
CFC Stanbic ranked pretty well. They are able to mobilize deposits. They have fewer branches, so the deposit per branch is actually really high. And if you look at their net non-interest income compared to the total revenue, is actually the highest in the banking sector.
Interestingly, while the majority of the big banks congregated in the middle of the list, Barclays Bank was ranked 9th after banks like NIC, DTB, and Cooperative Bank.
The deposit per branch have remained a bit low, and their reserve to NPLs have been lower. However, they have the highest net interest margin, so they are really able to mobilize cheap deposits.
National Bank ranked poorest of the 10 listed lenders, weighed down by lower profitability, efficiency, growth, asset quality, liquidity, revenue diversification, and capitalization. The bank earned 100 points, much lower than CFC's 58 points, and was 25 points below 9th-ranked Barclays Bank.
I can say it had the highest net cost-to-income ratio, and I think, to be fair to them, they are doing the restructuring, they're recapitalizing the bank and all that. So we actually think they're going to do well in the long term. They might not have done well right now, but I think there's still a lot of potential for them.
But with the new regulation targeting the banking sector and the rising competition from both within and without the sector, what does the future portend for banks? According to Seaton, the future remains bright.
Growth is still there. I think the banking institutions are really able to pass on the cost of the increased interest rates to the consumers, so they're able to maintain their net interest margins. So that said, we still think that there's potential for the banking sector.
Adelaide Changole, KTN Business.